Hello, I'm Adam Grimes, and welcome to the MarketLife Market Review for July 27th, 2018. So I'm going to do the usual thing today. I'm going to talk about markets and setups, and that's actually quite simple. But I want to put this up front and center because everybody needs to think about this, and we need to talk about this. I want to talk to you a little bit today about Facebook, and if you've been living under a rock and you somehow missed this move, this is a combination of earnings miss and comments in the conference call led to this open. Now, a few things. One thing that we don't need to spend too much time on, but it's interesting, is the impact of this move of a big stock on a major index. If you look today at, say, the NASDAQ against the Dow, you will see that there is, perhaps many people would argue, that these stocks are unfairly weighted or too important in the index. And that's just a function of index construction. The fact of it is that the biggest stocks, the handful of biggest stocks, well, without getting into specific, let's say like the biggest 5 or 6 stocks in an index many times are collectively as much market cap as several hundred in the index. So really it is quite heavily weighted to a very small number of stocks. You see a big move in a big stock like this, it's going to affect the market. So this is part of one of the things the market is laboring under. But the bigger issue is for you personally, for your trading program, how you think about risk and how you trade about earnings. I say this, maybe I don't say it enough. Maybe I should say it with flashing lights, but anytime you are trading a stock, you need to know when it reports earnings. And what you choose to do with that, I would suggest to you, needs to be consistent. So in other words, let's say that you're holding Facebook long yesterday. There are 3 lessons here. This is lesson 2. So you're holding Facebook long as of yesterday's close, and you know earnings are coming up. If you don't know earnings are coming up, you've got a problem. But you know earnings are coming up. What do you decide to do? Well, one possibility is you just ignore it, and you assume that earnings is potentially a big volatile event. Sometimes it'll work against you. Here's a case where it worked against you if you were long. Sometimes it will work in your favor. That is one legitimate possibility. It's not my personal choice, and I frankly don't think it's a good one. Other possibilities are you just get out of the position. And I would say if you're going to do that, then when you get into stocks, you need to be very aware of when they report, which really should be the case anyway. But you need to think, okay, if I get into a trade and a stock reports in 3 weeks, okay, you have time to make your play before earnings probably, right? Reports in 1 week. Well, now I'm kind of under time pressure, but at least with the way I swing trade, maybe I can get it done. Maybe that will make sense. Reports in 2 days? No, it makes no sense because there's just not enough time for the trade to play out and for things to work. So another possibility is that if you've taken partial profits, maybe you let the rest ride. You hedge with options. And now we're getting into lesson number 3, because I've had some frankly pretty disturbing conversations with people today where they look at a move like this and they say, oh, I could have done this and I would have been just fine. So in the future, there's nothing to worry about. One possibility that was suggested to me was buying puts. Buying, say, the 210s, which are probably pretty expensive, maybe buying the 200s. Now, this is a legitimate use of options. If you, in general, using a put option as a stop on a long position or vice versa. So you'd be long a put option, you'd be long the stock. The problem with that, of course, is there's a cost. And that cost is you're paying rent on the option, but really the biggest cost is that it's tied into implied volatility. And what you will find they do very consistently is jack the implied volatilities up, particularly on active stocks, before earnings. What this means in simple plain English is options get really, really expensive. And yes, you can always find, there's a lot of stuff floating around. People are talking about if you'd invested $500 in the 180 puts, you would, whatever. So this was one event like that, but we don't think in terms of one event. We think in terms of hundreds of trades, thousands of trades. We don't think about today. We think in terms of doing something over the course of a career, hopefully for decades. So I would argue, while using a long put on a stock, on a long stock position, is a reasonable proposition if you understand the cost. And be clear, it is going to take a big chunk of your performance out. For doing that before an earnings play, I do not think makes sense. One of the other things that I have been told is, well, look how easy it was to trade around. And so one of the other ways to deal with this is to say, okay, I'm going to have the trade on, and then if something happens with the earnings call, I'm going to get out of the position. Okay, that's a possible. So what you're opting for in that case is active management. Well, I want you to think about a few things. So first of all, some stocks report when the market is closed. So you could be in a situation where the market closes, your stock reports in the morning, and it opens up or down 50% or something like that. And you literally would not have a chance to make a trade. In the case of Facebook, it reported after hours. These are 1 minute price bars. And we never look. That's a 1 minute price bar right there. And it's probably, so somebody said, well, if you had a stop at 210, you probably could have executed your stop. I don't know, and I'm not going to drill down into a tick chart, but I'm betting if you had a stop at 210, you probably been filled 204, 205, maybe it wasn't quite that bad, but it is entirely possible that this 1 minute bar, printed 218 and change, and then the next print might have been 202. So when you look at historical data, this is from somebody who has done a decent amount of trading before and after hours. I want you to know that you can't always tell the story. In fact, you usually can't tell the story from the chart. There probably were not multiple places to execute in this bar. There may have been cases where the bid-ask spread was 15 points wide. Would not be surprised to see that. It might simply have, let's say it was 218 bid offered at 218 and a quarter. Then the next bid might have been 202. There might literally have been no opportunity to get out. And if not in this case, then certainly you'll see that in other cases, and biotechs are really scary in that case. So what happened with the Facebook was we had the earnings report and then we had the conference call. And if you ever would be holding a stock after an earnings move, I think at the very least what you need to do is listen to the conference call. Whether you actually listen to the conference call because they're kind of boring, they're kind of obtuse, and really what it is as much as anything is a bunch of analysts playing the Wall Street game. I've never personally been able to extract that much value out of listening to conference calls, but knowing when they say something and the market action. If you were, let's just imagine that you were still holding your long position here and you're watching it stabilize and the conference call starts and then it breaks to a new low. Well, here technical analysis is your friend. Here is a case where now don't think you would have gotten out at right under there with 5 cents slippage. You might have had a buck or two, a point or two of slippage. It's possible. Probably with good execution, you might have had less, but you also might have had more. You could have had 5 points. You could have had a corresponding drop like you had here. But I do think if you do intend for active management, and there seems to be a lot of people like this idea. If you do intend to manage these positions actively, just be aware of these possibilities, that it's not as easy as it seems on the chart. And before you make the decision, it's also a hard way to live your life. Let me just say that. It's an invitation for a lot of stress, and it's an invitation to lose money doing the right thing. You can certainly have cases where positions are stuffed against you and you did absolutely nothing wrong. So just be aware of that. Now, in terms of market setups, so I think we're still set up rather bullish. We had, if we look around the world, of course, there was some positive tariff news from President Trump and Europe, and Asia responded to that with, shall we say, cautious optimism. Remember, if we think like a short-term trader, this bear flag's getting a little long in Japan. It's getting a little hard for me to be excited about being short. I can be pretty excited about being short here in China, right? But I know if I take this trade that I'm kind of flirting with danger because I'm flirting with the top of the bear flag with this sloping flag here. So, and of course, a lot of the weight on the U.S. indexes today was Facebook. And we need to see what happens here over the next few days, but I still think that this is a much more subtly strong environment than people realize. Also seeing some moves in the dollar. Remember, President Trump is also advocating for a weaker dollar pretty strongly, and we see a lot of pairs setting up for dollar strength. So it's interesting to see that. And, you can decide how much of the whole political environment you take into account. But one thing that I would take into account is that this is pretty much the worst trading environment in currencies. Happens about once a year. This is probably about as bad as I've ever seen. So I would be a little suspicious of trades. Maybe if you normally would take 3 positions, take 1 or something like that. And you certainly will pay attention and see what the markets have to give us. Okay, that's all I have for you. Actually, this wraps up the week. I'll see you back over the weekend with more analysis. Thank you very much. MarketLifeTrading.com.